In recent years, you've seen headlines like commission-free stock trading. It sounds like trading costs nothing. Then tax season arrives and you discover capital gains, dividend tax, and maybe the 3.8% net investment income tax still take a cut. Wait, both stories are true. A lot of people mix these up. Brokers dropped many commissions, but that is not the same as the IRS stopped taxing profits. Every realized gain can still cost you. Today we'll walk the real dollars you pay on stocks, international holdings, margin, and short sales with concrete numbers you can check yourself. Imagine a stock like Apple on the chart. You buy $10,000 worth and later sell for $15,000. Your gross profit is $5,000. Hold longer than 1 year and a common federal long-term capital gains rate is 15%. On $5,000, that is about $750, so roughly $4,250 of the gain stays with you. Hold under a year and short-term rates, ordinary income can take 22% or more, over $1,000 on the same $5,000 gain. But taxes don't exist is still false. Even with zero commission, tiny SEC Section 31 and FINRA trading activity fees come out of cells, and the capital gains bill is the real cost. So on a $15,000 sale, the fee slice is pennies to dollars, while the tax on the $5,000 profit can be hundreds. Run the numbers yourself. The ratio becomes obvious.
Now look at trading something like SPY, the S&P 500 ETF on screen.
Suppose you book a $3,000 gain on a foreign stock or ADR in a taxable account. For U.S. taxpayers, worldwide gains generally count. There is no large foreign-only free allowance like some other countries advertise.
Short-term gains are taxed like wages. Long-term gains usually get preferential federal rates often 0%, 15%, or 20% depending on income.
Example, a $3,000 long-term gain at 15% is about $450 of federal tax. Compare that with the same $3,000 as short-term at 22%, about $660. Holding period changes the bill. One more watch out. If you also collect $500 of qualified dividends from a U.S. name like Apple, that is often taxed at those same preferential rates, roughly $75 at 15%. Ordinary, non-qualified dividends can be taxed like wages. Trading profits and dividends are separate lines on your return. Check your 1099s yourself. Suppose you want $10,000 of a name like Apple, but you only have $3,000 cash. Your broker can lend the other $7,000 on margin. Borrowed money usually carries interest, often around 10 to 13% a year, depending on the firm and the Fed's rate path. 6 months later, the position is up 30% to $13,000. You sell, repay the $7,000 plus roughly $350 of interest, illustrative at as a 10% annualized, and keep about $2,650 of profit on your $3,000 stake, near an 88% return on your own cash. But if the stock drops 30% to $7,000, your $3,000 of equity is gone, and you still owe the broker the loan plus interest. Losses scale with leverage. A move smaller than coffee going from $3 to $4.50 can wipe a thin margin cushion. The scariest part is the margin call and forced liquidation. If equity falls below maintenance, the broker can sell without asking. History is full of accounts that turned a small shortfall into multi-thousand-dollar realized losses overnight. Simulate the worst case yourself before you click borrow. You expect a stock like Apple to fall. You borrow 100 shares and sell them for $10,000. A short sale equals sell borrowed shares first, buy back later to return them. Borrowed shares usually carry a stock loan fee, sometimes a fraction of a percent a year, sometimes much higher if the name is hard to borrow. If the price falls, so the same shares cost $5,000 to buy back, you pocket about $5,000 before fees. Looks clean on paper. But if the price doubles to $20,000, you still owe those 100 shares, and covering now costs $20,000. Losses can keep growing without a fixed ceiling as the stock rises. Hard-to-borrow names can also be recalled. Your broker may force you to cover early. That is why short selling is extreme risk, not a casual hedge. Work the profit and loss math yourself before you ever short.
Picture the S&P 500 up about 15% over AEE. AEX Daily S&P Leveraged ETF sounds like it should deliver plus 30%, right?
In choppy markets, it often delivers far less, sometimes high single digits, because of daily reset math. The reason is daily rebalancing. Gains and losses compound path-dependently, and expense ratios, often near 0.9%, 1% plus a year on leveraged products, keep dripping out even when the index is flat. Structured notes and equity-linked products have traps too. Marketing may say enhanced yield, but if a linked stock or index knocks through a barrier, say 60% of the starting level, your principal can be cut. Historical cases of 30 to 50% losses exist when markets gap. Core idea: leverage and inverse ETFs are built for very short holding windows, often 1 to a few days. Hold them for months, and the math often works against you. Illiquid structured notes can be hard to exit early. Avoiding them from day one is usually safer than hoping to unwind later. Run a sample path yourself. 2 tax-advantage structures. A Roth IRA grows with after-tax contributions, and qualified withdrawals in retirement are generally federal tax-free. A traditional IRA or 401k can cut this year's taxable income. At a 22% bracket, $7,000 contributed can mean roughly $1,500 of federal tax savings that year. Combining workplace match, IRA room, and a taxable brokerage is how many U.S. investors keep more of what they earn.
What about IPOs?
History shows plenty of first-day pops above the offer price, and plenty of names that later fall 50% from the open. Average outcomes vary by year. Treat early aftermarket trading as high volatility, not a gift. Have an exit plan within days if your thesis breaks. Bottom line, margin, short selling, and leverage are not free opportunity. They are survival risks. Before you start, calculate the worst case. How large is the loss if equity fails a margin test or a short runs against you? Disclaimer: this lesson is for education only. Every investment decision is entirely your responsibility. U.S. tax and trading rules change, so before you trade or file, verify the latest guidance from the IRS, the SEC, FINRA, and your broker's official materials.